Happy Tuesday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Tuesday, September 26th, 2023. We'll start with today's key macro event, which is China's real estate crisis deepens and the Fed will be late to pivot. So, as asset markets take a shallow reprieve from the bloodbath in global sovereign debt markets that we perfectly presaged in early May, we are granted a fresh look into an old crisis abroad. China Evergrande Group's Hangda Real Estate Group subsidiary defaulted on 4 billion yuan, which is 547 million US, in principal and interest due September 25th. The deepening credit crisis triggered a minus 28% week to date plunge in Evergrande's stock price and caused authorities to detain former Evergrande CEO, I'm going to butcher these names, so apologies in advance, Zia Huijun, and former CFO Pan Darong. Elsewhere, Neil Kashkari of the Minneapolis Fed echoed comments by Boston Fed President Susan Collins and Fed Governor Michelle Bowman last week in suggesting the Fed may hike policy rates again this year. It is not clear why officials feel the pressure to tighten incrementally, given their Pollyannish forecast for growth, unemployment, and inflation. Their jawboning suggests officials are still reeling from the policy mistakes of 2020 to 2021 and are insistent upon maintaining whatever last semblance of inflation-fighting credibility the institution has remaining. Transitioning to my Bloomberg here, where we'll go through our daily rundown of cross-asset performance. We'll start with U.S. equity sectors. So the S&P down 2.6% week over week. It's still being led to the downside by consumer discretionary and real estate at down about 4.5% apiece. Healthcare is really bucking the trend, as proven to be the defensive stalwart that it historically has been at only minus 0.4%. Shifting to factor performance, as I mentioned, S&P down 2.6%. We continue to be barbelled by low beta only down 1.6% and high beta down 3.9%. Not getting a ton of dispersion from value and growth here. That down 2.2%, but growth down 3%. But again, we know that value tends to outperform growth in market declines. That's really the only kind of condition where value is persistently, at least according to our grid asset market backtest, outperforming growth. Transitioning to geographic performance, as I mentioned, S&P down 2.6%. We're being led to the downside globally by Brazil at minus 3.9%, and then led to the upside, or at least Japan is proving to be a defensive stalwart as well, given the kind of the persistency of institutional flows rotating into this asset class, going from significantly underweight to something that's probably neutral or overweight throughout 2023. Given some of the policy guidance we've seen on the microeconomic front in Japan. In terms of fixed income, we're just down 1.4% in terms of the Barclays Ag. We're down 4.6% in terms of the TLT. I mean, literally, this security cannot get out of its own way. Investors have had multiple opportunities in the last year to get the hell out of the bond market. We've certainly done a great job of helping investors get the hell out of the bond market and minimize downside capture in this asset class. I think we've done a decent job helping investors maximize upside capture in the equity market. But more so than that, I would argue we've done an even better job of helping investors minimize down capture. And again, it's not based on the words that I say out of my mouth. It's based on the quantitative risk management systems that are embedded in our systematic KISS portfolio construction process, which, as I say every week in the Around the Horn, even if you're not following along with KISS to the letter of the law, every ETF, every, percentage allocation, suggested allocation, you should be mimicking KISS in some form or fashion across the various asset classes in your portfolio, your clients' portfolios, because again, it's an extremely powerful tool and it's kept us on the right side of risk broadly throughout the year. We've obviously had our mistakes. Everyone has their mistakes, but our list of mistakes is way shorter than the average investor, and certainly way shorter than the investors who've really been losing a lot of money this year, short in stocks and long in bonds, worried about a recession that our model and the research said was not going to come to fruition, at least until we get into Q4 of this year, perhaps Q1 of next year, which is where we've been since last November. Going back to back to cross-asset performance, going back to currencies here, dollar is up almost 1% week over week. It's coming at the expense of the Swiss franc and the British pound here, down 1.5-ish% respectively. Looking at the commodity markets, where DBC is down minus 1.4% week over week. Commodities are being led to the downside by ag commodities, almost down 2%. Uranium is moving. It's been moving for the past couple of weeks. So there's obviously something going on in terms of investors getting excited about uranium. That's very specific to the uranium market, because clearly broader commodities aren't working, broader risk assets aren't working. We can see that in terms of crypto, Bitcoin, Ethereum down a little over 3% a piece here in the crypto space. Most cryptos are down. You got Binance Coin up a little bit on a week over week basis, but again, the trend has been lower since this time last week. And then lastly, we'll wrap it up with my Longbow dashboard here, specifically with respect to the trading ranges. The Bloomberg Dollar Index is getting to nearing overbought condition. We've seen this a couple times before. It takes a little bit of a breather, but it keeps on chugging higher, which is what it's been doing really since July. This is something that's been a headwind to global liquidity, in so much that the bond market volatility that we've experienced has been a headwind to global liquidity. We do a deep dive on liquidity in terms of what drives it, what leads it, and what ultimately how it's actually performing, what's likely to occur in the global liquidity space as it relates to asset markets every month in our in our macro scouting report presentation. And we've been as right as anybody in the world, including you know who, on the inflection negative in global liquidity going back to mid-April is when our model first spotted that inflection, and it's continued to get incrementally negative since here. So this is one of those reasons why crypto and stocks have diverged, because crypto cares a lot more about liquidity than your traditional financial services asset markets do. So we'll wrap it up there. Darius Dale presenting our macro minute for Tuesday, September 26, 2023. Best of luck out there today. We'll catch you back here tomorrow. Cheers.